Hello students, welcome to all of you Shiksha 360 CAP classes. Today we have to discuss the chapter number 10 of ABFM, that is Capital Budgeting for International Project Investment Decisions Part 2. So in this session we have to discuss some important points. What is beta factor, what is risk factor, all these things we have to be covered in this session. Okay, so in the previous session there is one numerical which we have to cover, which we will cover in the end of the basically in the third part we will try to cover that numerical, okay, because I want to discuss some other concepts in this session. After that we will try to cover that. So now let's start our discussion. So first of all, here we have to understand regarding the what are the direct and indirect channels basically for the international portfolio investment. Clear? So this will be the 1 mark question. Direct and indirect. So domestically, basically we have direct equity, equity mutual fund, debt mutual funds, NPS, PPF, bank FD, senior citizen savings scheme, company deposits, etc. Clear? All these things basically comes under the domestic channels. Internationally, basically we have American depository receipts. Clear? Internationally, basically we have American depository receipts, global depository receipts, foreign direct investing, global mutual funds, exchange traded funds, and multinational corporations. Clear? So basically we have both that domestically as well as internationally. Clear? Domestically we have already discussed that direct equity mutual fund, debt mutual fund, NPS, PPF, bank FD, senior citizen savings scheme, company deposits, etc. On the other side, basically internationally, basically we have ADRs, American depository receipts, GDRs, global depository receipts, foreign direct investing, that is, or after that global mutual funds, exchange traded funds, ETFs, and multinational corporations. So in case of the indirect channel, in case of the indirect channel, the investment is made into certain intermediary. Clear? In the case of the indirect channel, here basically what will happen? The investment basically it is made in, into certain intermediary. In the case of indirect, clear? Basically how basically like mutual funds who will in turn invest into various sectors. So by opting for the direct channel, basically what we have, basically we use ADR or GDR issued by the corporates. Clear? So kindly remember that in the case of indirect channel, okay, so the investment basically made into certain intermediate like mutual funds. And in the case of the direct channel, basically we have ADR or GDR, that is to be issued by the corporates, foreign direct investment route, where the investing company uses the funds basically for its own financial requirements. Clear? Along with that, basically there are also number of sites of the Marriott basically which allows you to invest online. Clear? Presently, I think you will know that basically there are a lot of sites basically where you will do the online investment presently these days. Okay, so just remember that what are the domestically, what are the internationally, what are the direct, and what are the indirect here. Now we have to move to the next one, that is exchange risk and country risk. Clear? So what are these two things? Clear? Like what is exchange risk and what is country risk? Clear? So now we have to discuss regarding that. So these risks are typical to the foreign investment. Clear? So these risks are basically typical to the foreign investment. Exchange risk was, what is that? Exchange risk basically relates to the value of your investment. Clear? What is exchange risk? Basically, exchange risk basically relates to the value of your investment going down in the terms of the local currency due to the depreciation of the local currency or the appreciation of the foreign currency of the investing country. Clear? So what is the meaning of the exchange risk? That is your country's basically currency, it is going to be depreciation. Clear? So exchange risk basically relates the value of your investment going down in terms of the local currency due to the depreciation of the local currency or appreciation of the foreign currency of the investing country. So currency valuations are affected by many local or international events. Clear? So currency valuations basically are affected by many local or international events or economic performance of the concerned countries. Clear? Or economic performance of the concerned countries. Like basically sometimes these things are also happen. Let's to play an important role, like wars, sanctions, embargo, pandemic, fiscal policies, etc. are some of the factors here. Clear regarding the currency fluctuation. Further, that is the country risk. Clear basically what country risk basically includes here. Country risk basically includes the political developments, liberalization or restriction on the free trade, local laws, regulations and legal system, social or political turbulence or instability, revolts, elections and change of governments. Clear? All these things basically comes under the country risk. Clear? So here basically country risk basically includes political developments, liberalization or restrictions on the free trade, local laws, regulations and legal system, social or political turbulence or instability, revolts, election and change of governments. Clear? All these things basically comes under the country risk. Clear? So kindly remember that exchange risk basically it is related to what? Related to the investment, either basically due to the local currency, basically due to the depreciation, the value it is going down, or there is a appreciation in the foreign currency. Clear? Or there is appreciation in the foreign currency. Clear? So kindly remember the difference, both these things. Clear? What is country risk and what is exchange risk? Clear? Because in the examination, they will ask question regarding that. So now next one. Just try to understand all these things because all leads to the formation of the numerical. Clear? To understand the numerical. Return and risk of a foreign investment. Clear? So what is that? That is the return and risk of foreign investment. So the return of a foreign investment, like any other investment, depends upon the type of the asset. Clear? So the return of the foreign investment, basically like any other investment, basically on which thing it depends, basically depends upon the type of the asset, whether that is to be a liquid, growth or long-term, basically with the risk. Clear? Whether that asset basically it is a liquid asset or growth or basically long-term, basically with the risk. More liquid the investment, clear? Basically more liquid the investment, lesser is the return because liquidity ensures less risk. Clear? That is you can easily convert that investment basically into the cash. So it also depends upon the product as well as the restructuring of the same. While secured asset basically gives less return and the unsecured one basically gives you a better return. Why? Kindly remember that basically secured assets less return, but definitely you will know that basically this much amount basically you will get in the upcoming period. On the other side, unsecured assets on the other side, what will happen in the case of the unsecured asset? That is basically more return, more risk. You will know that, never know that basically whatever you will invested in that, either you will get at the time of the maturity or not. Clear? Even there is not any guarantee under that. Even that is the principle. Whether you will get that principle or not, there is nothing, any guarantee under that. Clear? So kindly remember these things. What is the meaning of all these lines to be here? Further, an investment in a country. Clear? That is an investment basically in a country with the stable or strong foreign exchange rate performance. Clear? An investment basically in a country with the stable or strong foreign exchange rate performance will provide better results. Dividend accumulations or reinvestment plans provide higher returns than those, basically than from those where dividends are to be distributed. Clear? So kindly remember that basically dividend accumulations or reinvestment plans provides higher return. Clear? Basically what they will do, basically provide the higher return than from those where dividends are going to be distributed. compared to domestic one, and international investment basically can offer better returns as the country of investment generally are well or better managed economics. Clear? So like basically it depends upon country to country. Like basically you can say that if you are invested in a growing country, clear, or a developed country, so basically it means that we can think over that our funds basically will rise, clear, that our funds basically will rise, clear, or basically we can get better return under that. On the other side, basically if we are invest basically in that type of country basically where the political situation in that country it is not fine, clear, continuously we can say that political structure it is not good, international relations it is not good, so basically in that country investment it is not fruitful, clear, investment basically it is not fruitful in that country. Now move to the next one. So apart from the usual risk, any investment pauses. The international investment, it is also subject to the exchange and country risk. Clear? So apart from the usual risk, any investment pauses the international investment. It is also subject to the exchange and country risk. Clear? That is also subject to the exchange and country risk here. So war, economic policies, sanctions, form of country governance, social goals, etc. Clear? Further, that is the economic and trade policies having bearing on the investment climate and returns as well as the risk. Clear? All these things also comes under that. Clear? War, economic policy, sanctions, form of country governance. Clear? How the basically governance of that country it is going on, social goals, etc. Further, determine economic and trade policies having bearing on the investment climate and returns as well as the risk. Clear? And returns as well as the risk here. Okay, so that is regarding the risk and return of the foreign investment. Now, how we have to calculate? This is the first model, that is CAPM, capital asset pricing model. Clear? CAPM, that is to be known as the capital asset pricing model. So first of all, here you have to remember the full form, that is regarding the CAPM, that is capital asset pricing model. Clear? So the abbreviated term CAPM basically describes the relationship between the risk and the return, or specifically basically between the systematic risk and the expected return. Clear? So basically what is a CAPM? Basically it is a relationship between the systematic risk and expected returns. So the returns are always basically based on the risk and the time value of the money. Clear? Basically for how much time basically you are investing. First thing that clear. So the returns are basically always based on the risk and the time value of money. So for pricing of a particular security or investment product, one has to undertake basically quite a few analysis. Clear? That is basically they have to do a few analysis. So under that first method, that is the CAPM. Clear? We have to discuss two methods here. First one, that is the CAPM, that is the capital asset pricing model. Clear? First method here, that is to be known as the capital asset pricing model. So this is generally done for the risky assets. Clear? So that the price paid is appropriately to generate expected returns. Clear? So this is generally done basically for the risky assets, so that the price paid it is appropriate to generate expected returns. Basically one would like to find out, clear, basically one would like to find out the risk-free returns over a time. Clear? Basically one would like to find out the risk-free return basically over a time. A beta is generated. Clear? Beta basically with the help of that basically we are able to measure the risk. Clear? So beta it is generated, which is a measure of volatility. Clear? Which is a measure of volatility or the systematic risk compared to the market as a whole. Clear? Which is a measure of volatility or the systematic risk basically compared to the market as a whole. Clear? So how it will work? Now let's try to understand. So security beta, further basically what it tells, that is security beta is calculated by dividing the product of the covariance of the security returns and the market returns by the variance of the market returns over the specific period. Clear? So how we can calculate the security beta? First of all, dividing the product, that is covariance of security return into the market returns by the variance of into the market returns, basically by the variance of market returns over a specified period. Clear? Over a specified period, basically from that we are able to calculate the security beta. Further, if it was possible to accurately forecast future cash flows, so this type of derivative method basically would not be necessary. Clear? Basically, if we are able to forecast actually, clear, but that will not be possible in that much. Basically, we can say that basically actually we cannot go with that much accuracy. However, that not being the case, basically an investor would like to depend upon such pricing method. Clear? So just you have to remember that how basically we have to calculate the security beta. So now let's try to understand the formula here. So calculation of the CAPM. Clear? So how we have to calculate the CAPM here. So kindly tell fast if anyone remember basically what is the full form CAPM, which we have covered in the previous slides. So basically that is cost of equity is equal to cost of equity, it is to be known as RE here, is equal to the risk-free rate plus levered beta into the market risk premium. Clear? So cost of equity, that is RE, is equal to RF, risk-free rate, that is RF, levered beta, that is beta, into market risk premium. Clear? Market risk premium, that is RM minus RF. So RF basically here, that is the risk-free rate, beta L, that is the levered beta, RM, that is the expected return on the market, and RM minus RF, that is the market risk premium. Clear? And RM minus RF, that is to be known as the market risk premium to be here. Okay, so this is the basic formula. On the basis of that, which we have to solve all the questions. Clear? There will be two. First one, CAPM, that is which we have already covered, that is the capital asset pricing model. CAPM. Now move to the next one, that is the detailed discussion of all these things. Clear? So what is risk-free rate? Clear? So what is risk-free rate or RF? So the expected rate of return on an investment in a security. Clear? The expected rate of return on an investment in a security considered to have no inherent risk. It is referred to as the risk-free rate. Clear? Considered to have no inherent risk. It is to be referred as the risk-free rate. So the actual risk-free rate that is used in the CAPM shifts depending upon the yields. Clear? So the actual risk-free rate basically that is used in the CAPM shifts basically depending upon the yields that are currently available basically for that specific selected security. Clear? So the expected rate of returns on an investment in a security basically considered to have no inherent risk. It is referred to as the risk-free rate. Clear? So basically where there is no inherent risk. However, the actual risk-free rate basically that is used in the CAPM shifts basically depending upon the yields that are currently available basically for the selected security. So next one, that is what is the market risk premium. Market risk premium basically how either it is to be known as the MRP or RM minus RF. RM, what is that which we have already discussed? That is the expected return on the market. RF, that is the risk-free rate. That is to be known as the market risk premium. Clear the difference between both of them? It is to be known as the market risk premium here. So the difference between the expected return on an investment and the risk-free rate, basically it is to be known as the market risk premium. Clear? Because why I'm discussing all these points, like sometimes basically they will ask in the examination case study type thing. So basically if they are asking any case study type question, so basically they will ask all these points in the form of the question in that specific case study. so that all of you are able to remember all these points so that you are able to answer the question. Now, next one, that is one more thing which we have to discuss now, that is beta. So what is that? The S&P, these are the indexes, clear? The S&P 500 index has traditionally been used as a stand-in for the market when calculating the beta, which is a measure of the covariance. Clear? What is beta basically? Which is a measure of the covariance between the rate of return on a company stock and the rate on the overall market. Clear? And the rate of the overall market. Clear? So what is the beta here? Basically, when calculating beta, basically, which is a measure. Clear? Beta, what is that? Basically, which is a measure of the covariance. Clear? Basically, what is that? Beta, which is a measure of the covariance between the rate of return. Clear? Basically, between what? Basically, between the rate of the return on a company's stock and the return on the overall market. Clear? Between the rate of the return on a company's stock and the return on the overall market. Clear? That is to be known to be as the beta. It is a covariance between the rate of return on a company stock and the return on the overall market. And basically, you not need to have calculated that. Clear? So all these values, basically, they will be provided you in the form of the questions. And just you have to use that values and move towards the answer here. So now next one, that is like basically we have already discussed CAPM method, like capital asset pricing model. Next one, that is the arbitrage pricing theory. Clear? This one, it is the another method. Clear? So this is an alternative method to the CAPM. While CAPM basically takes into account security returns and the market returns. This method or theory basically goes beyond it, thinking that market sometimes misprices the securities. Clear? Basically, under that, basically we have taken the security returns and the market returns. Basically, this method basically says that sometimes there is misprices of the securities. So arbitrage pricing theory therefore tries to take the advantage of any or many arbitrage opportunities or derivatives in the market or economy. It uses the linear relationship. Clear? Basically, what they will use? Basically, it uses the linear relationship between the assets expected return and a number of macroeconomic factors or variables that affect or capture the systematic risk. Clear? So what is that? Basically, it uses the linear relationship between the assets expected return. Clear? Between the assets expected return and a number of macroeconomic factors. Clear? Basically, and a number of macroeconomic factors or variables that affect or capture the systematic risk. Clear? And a number of macroeconomic factors or variables that affect or capture the systematic risk. Like further, that is, what are the factors here? That is GDP, domestic inflation rate, stock indices, gold prices, risk-free rate of the interest are such factors. Clear? Now we have to be taken beta factors. What are the beta factors? And try to calculate the risk. Clear? Try to calculate all these things here. Clear? So that is basically under the arbitrage pricing theory, basically GDP, domestic inflation rate, stock indices, gold prices, risk-free rate of the interest are all such factors basically which we have to check here. So now let's try to understand basically with the help of the example. For example, the following 4 factors have been identified as explaining the stock returns and its sensitivity to each factor, and the risk premium associated basically with each factor have been calculated. So RP, that is risk premium. So gross domestic product, the beta here, that is 0.6, and risk premium, that is 4%. For the inflation rate, basically beta it is equal to the 0.8, risk premium, that is 2%. For gold, beta it is equal to 0.7 minus 0.7. Risk premium, that is 5%. For Sensex index return, beta is equal to 1.3 and the risk premium it is to be 9%. The risk-free rate it is to be 3%. So now what is the basically expected return? Clear? So how we can calculate the expected return? Just basically we have to use the APT formula, that is arbitrage pricing model, pricing theory, sorry. So what is the expected return? Just we have to check out that expected return, that is 3%, that is the risk-free rate, plus beta basically for the gross domestic product, beta into risk premium 0.6 into 4%. For inflation rate, beta 0.8 into 2%. Clear? Here it will be minus, so basically plus minus 0.7 into 5%. 1.3 into 9%. Clear. So overall, basically, we will get the 15.2%. Clear. So this will be the expected return here. Clear. By checking all these things. Clear. So using APT, basically arbitrageurs can take advantage of any deviation basically from the fair market value. Clear. From the fair market value. Basically, with the help of that, they are able to analyze clear basically where it will impact that. Okay. So please tell fast now up to this much point. It is clear to all of you. Just you have to understand these things. Whatever we have covered. Clear in the examination, they will ask questions directly from these things, whatever we are covering. Clear. As we have already know, basically they are asking everything from the book, but we have to understand that things properly. So please tell fast if anyone has any doubt, any query regarding that, what we have discussed till now. Clear? Because in this session, we have to cover up to this much point. In the next session, basically, we will cover one more topic. Clear to all of you regarding the CAPM? What is the formula for that? Clear? So this is the thing basically we are using here. Here only one thing. And in the next, basically, we are using multiple. Clear? Like whatever they are mentioning, like inflation, gold, Sensex index return, clear, GDP, all these things we have to be covered. Any doubt or any query you can ask here. And I will upload some questions in the evening regarding that, clear. So you can practice that question and try to understand what type of the question they will ask in the examination. And thanks to all of you for joining this discussion.